Thank you, Alison.
Thanks, Jonathan.
Okay.
Yeah, please. Good morning, ladies and gentlemen, and I'd just like to say thank you for those that have turned up this morning. The party last night was spectacular, so I'm glad to see some of us have the stamina to be here quite as early this morning. You know, when I left PwC after a lifetime of being in consultancy, I got accused by my colleagues of joining the dark side of industry. I think the last few days have really reinforced what I think I already knew, that I wasn't joining the dark side of industry. I was actually joining the bright side of Razelkheimer, and I've never been happier that I made that decision. 2017 was quite a subdued year in terms of hotel construction projects. 2018 is due to be a record-breaking year, with $14 billion of construction projects due to be awarded this year. Now that's going to need a lot of financing, and I'm delighted to be joined here today by the panel. We have a mixture of owners and financiers who are going to help discuss how we find that finance. What are the products we should be looking for? What's important for the owners, and what is important for the finance providers. Gentlemen, thank you for joining me. Please, can I ask you a little introduction about yourselves?
Absolutely. Cyril Piaia from Stratford and Russell. Basically, we are a company providing real estate financing and hospitality advisory. Previously, the last 12 years in Oman, chief executive of two main developers, one being Orascom, another one Mustia in Oman.
Andrew Lindley from Action Hotels. We run 3- and 4-star properties in 6 countries at the moment, 7th coming up soon in Saudi. And we see a big growth in the 3- and 4-star properties in the next decade or so. So we're hopefully our first mover vision from Sheikh Mubarak Al Sabah from Kuwait will see us in good stead.
Good morning. Shane Moore is my name. I work on the real estate financing team and banking team in Standard Chartered Bank. Focus on EMEA, based in Dubai, and then sort of main coverage is sort of MENA for both inbound and outbound transactions.
Good morning. Alejandro from Abu Dhabi Commercial Bank. I'm in the investment banking side, looking after real estate, project finance, infrastructure finance, product partner.
Thank you. I'm going to start, Andrew, with yourself. You know, as a fellow owner, I know this is close to your heart. Given that we are expecting so many deals to come onto the market, so many construction products, what is the types of financing that you're looking for? You know, have we got too conservative with the types of financing? Do we need to be more flexible? Do we need to be a little bit different to what we've seen as financing deals in the past?
Sure. I mean, we've opened 7 hotels in the last 2.5, 3 years, and obviously all of those have needed financing. So we have had very good support from local banks. We operate in 6 countries, so we see different financing products, different services and structures, and therefore bring quite a lot to this territory as potentially education, but also pushing the boundaries to what else is out there. And one thing we were just chatting about at the back was that in maybe more developed countries, such as Australia, we see interest only or 100% bullet payments. Now, there's, I'm sure a lot of bankers will take a deep sigh, a gasp when they hear that, but you know, that is hopefully where the market is going in the Middle East. As owners, we're pushing for that. Hotels take 2.5, 3, 4 years to mature. If they're in the right location, you can have 70, 80% occupancy almost immediately, and that's understood. But at the same time, many hotels take quite a while to get up to their running cash flows, and that's what the banks want. So, and that's what the owners want. But a bullet payment allows for investors, hotel investors, developers and asset managers to reinvest that surplus funds and be able to grow quicker, take more opportunities. So yeah, the first question or first demand, if you like, is that where the Middle East banking is going? Have we pushed hard enough, or do we need to push harder?
And I'm seeing shock and horror at the other end of the panel.
Should we look at this way or this way?
Look, from our perspective, and it's slightly different than maybe the more local or regional banks. We've obviously got a more international sort of view given our footprint. And from a sort of a real estate point of view, which includes hospitality and every other sort of major food group in the real estate world, we are guided by sort of underwriting standards and how we can go in, think of it like investing and nearly like co-investing from a debt point of view versus an equity point of view. So we kind of have sort of benefits other than, maybe more so than local banks, of looking out at other structures in sort of Asia or Europe or US, as you've sort of alluded to. So the bullet type structure is actually very much within our remit and something that we're very comfortable with. It's generally how real estate is financed, subject to leverage and many other terms and conditions. But from our perspective, it's definitely something that we can do, subject to tenor, etc. I think, though, that's very sort of micro. Looking at it sort of from a wider perspective, the banking world is not just about you. It's about our sort of peers and sort of, sometimes ex-colleagues in other banks, and working together and creating solutions for clients and getting the right package and being able to actually come across with a workable solution in the geography you're in. So sometimes that is easier when you've sort of got less banks, and when there's more, then sometimes there's more people inputting into the needs and wants of a particular structure. So having said all that, it is in our experience, because we've been trying to sort of peddle this a little bit more, and from our point of view, from a banking point of view, it's probably nearly better, because you've no amortization, you've lower leverage, you've sort of more constant revenue streams, you've more, it makes sense from both sides. But we are seeing a little bit more movement with our sort of peers, and they seem to be more open to this type of structure now. But
if you want to, from a local point of view, it's a little bit more challenging. It's slowly moving into, if you want to, the full bullet. When I started working for ADCB 7 or 8 years ago, it was a fully amortizing facility. Now we're doing 50% bullet, which allows for extra cash going out. So slowly, it's moving towards that direction, but we're not as developed as Standard Chartered is. So it is going to take a little bit more time. But it's also having control over the cash flows that Shane was referring to, knowing where they're going, because if money is going out and bank is not getting repaid, that's where we have to balance the stakeholders.
And Cyril, from your side, are you seeing flexibility in the marketplace?
Not really. Actually, from my perspective, I think banks have somehow to adapt to the life cycle of an hotel. And actually, all the schedule of loan reimbursement, the grace period, starting reimbursing the principal, should be directly linked to the situation of the hotel. I mean, maybe for you as a mid-scale, you get quicker break-even on GOP, but for us, we had the experience for a 5-star type of resort. The first 2-3 years, the owner keep on injecting equity to cover the cash losses at operating level and investment level. So somehow, and you have, the story is not so easy as well with contractors who are delayed in delivering the hotel. And we face situation where we have to start reimbursing the principal even before the opening of the hotel. So we have to go back, negotiate an extension of the grace period. And then even when the hotel is open, it's not a very quiet life for the first few years. So bankers, in my opinion, should be really part of even the design team of the hotel. Should be really much more involved in the understanding about how it goes in terms of operation for the first few years, and be very supportive on that. That's something that is not yet done, in my opinion.
No, I mean, just from our perspective, we definitely are. We're very into the detail on the assets, and especially during construction period designs, all that. We need to understand how the hotel is going to penetrate and perform, and we're very thorough on that. And I think matching the financing to the life cycle of the hotel is very important. Otherwise, you start getting into difficulty.
The saying used to be, build it and they will come. It's now changed to build what they want and it will come. Are you seeing the deals come across your desk that are still 5-star luxury, or are you now starting to see the deals coming into the 3-4 star mid upper scale?
Me or you?
From 80s, so what we have been seeing lately, it's or still a lot of 5-star hotel, which is all good and fair because this is more or less the market where it's here. But slowly, we've been seeing the resurrection of the 3-4 star, which is, as we were discussing, I think for me, it's where the next generation is going to be. There are a number of hotels in Dubai, in Ras Al Khaimah, not that many, in Abu Dhabi, some of them. But definitely that's the market that we believe it's going to eventually kick in. And that's where we are very much keen in supporting, because that's where the cash flows, the cash flow generation is much more stronger and much more predictable than with the 5 stars. So we're very much keen on basically supporting those kind
And
of
are you
industries.
structuring your projects different if it is 5-star as opposed to 3-4?
Very much so, because at least from ADCV's point of view and the investment banking side, we just focus almost specifically on cash flows. We have obviously some LTV covenants and construction costs and the likes, but we focus almost 97% on the cash flow generation, and that's the one that basically pays us back.
Yeah, I mean, I've been looking at hotels from a financing point of view for a long time, and you need to, I mean, it's all about the cash flow and conversion to free cash, and that's from a lender perspective. So the asset is obviously important from a covenant point of view. That sort of goes without speaking, but from a sort of a 5-star, 3-star sort of preference, we'll take every transaction or every client sort of bespokely as well. So we'll still look at 5-star, we'll look at 3-star, we'll look at 4-star. It's more about the transaction, and it's actually, from our point of view, it's a very client-led. So it's about the client, it's about the overall relationship, it's about the capability. So it could be a 5-star hotel or it could be a 3-star hotel. We don't mind. We're obviously conscious of what the market is doing and where the supply is coming from and where the needs are. So from a 3 to 4-star perspective, it seems to be a bigger need. Therefore, obviously, it will be an easier discussion in credit. But ultimately, it does come back to the sort of that client transaction and sort of structure as well. So we're not averse to anything. We'll help where we can.
It is also tied up to the location. There are some locations that require a target for a 3-4 star hotel, which has not much availability in the market. Whereas some other places, some other locations, I catered for like a 5-star luxury, swimming pools, villas, and beaches, resorts. So that's where the balance needs to be found.
And one of the hot topics that we're always talking about when we're looking at what's being bought in terms of equity, and if that equity is coming in terms of land, how is that impacting the decisions and the deals that you're coming up with? Are we costing that equity contribution correctly?
From our perspective, it's always a discussion point, and it comes back to the client and the transaction and the overall. But back to our sort of underwriting guidelines and how we assess these things, we generally have sort of covenants set around with cash equity in as well. So we won't just look to land. We will need some further cash from a construction point of view, especially in the construction deals. So you'll need to, there will be some need in there, and if there isn't, there needs to be other sort of mitigating factors across the entire structure or the relationship or the client that we can kind of point to mitigate that. So it's always a discussion, but the preference is to have some further skin in the game, to use a banker's expression.
And on the owner side, how are you dealing with that? I mean, is it different if you're seeing competitors with land banks compared to if you don't have that land bank in your portfolio?
Well, we have a land bank ourselves, you know, one plot of land, and equity's been put into that. You know, the investment has been there already, unencumbered. So we see that as our skin in the game. Now, we understand, and with the breadth of a balanced portfolio of not only hotels with operators, also banks with loans. You know, we have 5 or 6 different banks, and so each one has their own criteria for, as you'd expect, for either construction finance or term loans. So we've got a fair balance of the market to what banks expect, and that's where we can leverage with other banks or banks that we'd like to start a relationship with. That, you know, the market or other banks are going in a certain direction. We're not averse to putting equity in. That makes perfect sense. But at the same time, as a PLC, as a company that's listed, we need to give a return to shareholders. So I suppose it depends where you are in the development life cycle. You know, speaking from my point of view, we've opened 6, 7 hotels in the last 2 years, so we're in a big development stage at the moment, and the support of cash flow is needed. It's needed from the owner, and it's needed from the banks.
And so are you seeing similar?
Yeah, actually, the land issue is a recurrent and an issue for the developers in the sense that, of course, banks are not including the land into the package. However, the developer has somehow to pay the land through the SPV, through a joint venture with another partner. And in that region, we know, all of us, that land can be quite a burden in the total development costs of the project. So that's why from our side, we are trying to push to reduce the cash equity brought by the developer through some kind of innovative financing that is not really used currently in hospitality, with an EPC type of contract, where we are bringing export finance, for example, from China, and the loan being taken by the contractor. So we succeed sometimes to reach 85% LTV, which reduce the cash equity from the developer to be able to bear the burden of the land in the SPV.
Yeah, I mean, ECA is something we're seeing a lot of as well. It's very restrictive on suppliers, though. You have to be very sort of fixed in what you're doing. There is opportunity to push leverage. But I think ultimately the development has to make sense, whether it's ECA or senior secured debt. And once it does, then as I said, discussions can sort of morph and move.
Yeah. I mean, given the size of the amount of investment that's going to be needed, it's not all going to come locally. But historically, we haven't seen a lot of foreign investment coming into the region. Do you see that changing? Are you seeing a change in appetite?
Well, we have to, specifically because some of the projects are very, very large in size. So we will definitely require international money coming in, which has, over the last couple of years, sort of like dried out. But because now we're seeing even bigger and bigger jumbo loans being required for projects that are basically greenfield and needs to be developed from scratch, we will require not only international finance but also some other investors that we are going to be bringing along with us as equity partners. And to your point, that equity, how we are looking into bridging the gap, we are sometimes even delaying equity, basically cashing equity coming in to provide for debt support at the beginning, but the land and equity and the actual cash at the end of the day has to be somewhere there.
Yeah, I mean, I suppose simply, but we are seeing interest, given our sort of footprint and discussions in sort of the wider Asian sort of market. In the hospitality world, it's probably more operator-led, coming in with an operating strategy and maybe some equity as well, and working with landowners or through joint ventures. Pure play acquisitions, we've had some dialogue, but not a huge amount of success in getting that over the line. Sometimes as always, there's the bid-ask spread, which is the issue, and the perception of value. But as that kind of gets sort of, as everything develops and continues to develop the way it is, and the market is really developing fast, and it's one of the top in the region, and the UAE is one of the top hotel destinations in the world, simple as that. More capital will definitely be drawn here more often. And it's just a question of that whole story, I think, kind of playing out a little bit more. But there's definitely interest. It's just a question of, from what we're seeing, it just needs to be pushed over the line, I think.
I think Andrew and Cyril set out what some of the things that they wanted from the financing arms were, what's important to them. What's important to the banks at the moment? What's the sweetheart deal that would come across your desk?
Again, for example, 3-4 stars hotels, the lack of 3-4 star hotels, that's something that we see as a potential niche to tap on. A product that will have recurring visits and recurring cash flow being generated, and that's a difficult one to judge, but that's definitely something that is required. Some hard equity, not just land and coming along, as I said, at a certain point in time. That's definitely something. It's a big one for credit. It's a massive one for credit. Actually, having some skin in the game, as Shane was referring to. Brands. Some brands have some extra value that people are willing to pay for, and some sort of track record, not only from the operators but also from the management.
And is that what you want to hear, Andrew? Is that what you're ready to take?
It is, but I think when you talk about disconnects or matching products for developments, we, and I'm sure many other owners, depreciate our properties over 50 years. That we don't build for them to fall down in 10 years. Yep. We build for them to stay standing and generate cash for a long time, and probably even longer than 50 years. Some of us won't even be here to see those benefits. But that's where the disconnect is, and I think that's where elsewhere in the world, I keep coming back to it, but the bullet payment, the interest only, really is an indication that there's the recognition that a loan on a property can stay there. There's no harm in it being there for 10, 15, 20 years. Is there a nervousness in the Middle East particularly? Maybe, yes. That's certain scare stories that have happened. But at the same time, you've got to match the client and their reputation and so on with the property, or whether it's a hotel or a residential or commercial. For the period of time that it's going to be standing, which is a considerable amount of time.
So how do we get past this longevity disconnect?
I suppose there's different sources of capital, so to speak, in the wider world, from a funding point of view, from a debt point of view. commercial banks, and if you take the US, for example, you've got a commercial bank solution, you've got a CMBS solution, you've got a life co type insurance company solution, and each one of those has different parameters on what they can invest in or what they can provide. So generally there, just as an example, your shorter end of the tenor, 5 to 7 max years, is probably your commercial banks. Your longer dated paper is in the CMBS Lifeco type world, but it's more stabilized type assets there. They like cash flow, they like recurrence, and they like visibility and track record, etc. When you're so it's about matching the funder to the product type. So if you're just sort of saying, oh look, I need 10 to 15 years, naturally banks, that's not in their, it's not in their sort of DNA, so to speak, to go that far. Now, I don't want to get into regulatory issues and all that, but certain banks are governed by different issues around. We have our own regulator in the UK, and we have guided by certain guidelines. So simply put, the longer the tenor, the more risk-weighted assets we have to set aside, the worse returning the loan is, right? So from our perspective, from a lender perspective, that's always a consideration. So that's sometimes a constraint. However, that doesn't mean that we're not useful to you in the 3 to 5 year type world, to the get it built, get it up and running, take a view, and then you go and you tap the longer dated sort of paper buyers but the sort of problem is the development of the market, they're just not quite here yet, and they're coming, I think. We're trying to. But sort of from a local bank and an international bank point of view, I think we can marry that sort of, or plug that gap. So sort of taking that type of a view maybe may help as well, right? So sort of trust the banks and trust the market and trust the fact that you're going to get refied out when you've built it and stabilized it. It's going to get refinanced out, and there's a market there for it. You know, there's over 50 banks in the UAE. It's a fairly liquid, market.
So you're advocating more, there's not one product that's going to fit the whole life cycle, but it's a change in the type of financing depending on where you are.
And it has already started. There are some REITs, there are some a number of different products that you can tap onto. If a hotel it's been just built, it's impossible. It's very difficult, or it will be very difficult to tap into investors with a 10, 15, 20 years horizon. Whereas if the hotel has been up and running for the last 5 years, it has a track record, the management, the hotel operator, it has been proven. It's a proven case. It's much easier for you to basically tap onto project bonds and other sources of liquidity that are long dated. So that's eventually where it's going to end up. And we have at least 4 or 5 discussions with clients to basically go on to or move on to from the 5-year type of facilities onto a 10, 15 plus years with even 50% bullets. Not 100%, but we're getting there.
Yeah, and it's not just the other source of the debt capital markets is always a solution as well. Like, it's not just the loan product, but there are other types of investors that fit into the insurance companies and CMBS world that are more fixed income type investors as well, but it comes back to the timing and the life cycle of the development. If it's built or just built or stabilized, or it's got a 5-year track record, then your options sort of open up exponentially, effectively.
And do you think we'll get there? I mean, Cyril, in 3-5 years' time, do you think we'll be sitting here having a different discussion, or will the conversations be the same?
Well, I hope so.
We'll come back.
Yeah, Alejandro, you raised an interesting point. You talked about a brand and the value with the brand. Yep. Is it a firm belief there is a value in the brand when you're looking at a financing deal?
Well, the brand itself, the benefit that basically brings along with is the fact that the power that they have to dictate terms are stronger than other weaker brands. So not putting names, but Jumeirah's, Atlantis, and these clients, they have, because of who they are and because of the basically number of keys that they have in different areas, they can dictate terms, and they can basically get better terms for them, which is going to allow extra cash going out and reinvestment, which is definitely something that we as bankers want to see, because so long as you see the cash that you don't get being reinvested in something else, well, it's music to my ears.
And I think a lot of what we've spoke about has been in relation to portfolios of assets. What's different? What advice would you have for the single asset owner?
From approaching a bank point of view, or
Yeah.
do the banker's job for him. Just make it easy and come in with obviously they will know the project, they will have everything sort of progressed from feasibility studies to projections, to brands, to analysis, to comparisons from an operating point of view, from valuation point of view. Just have a sort of a relatively complete sort of package, and then just come in and have an open conversation. I think coming in too early sometimes is more difficult for banks, because ultimately who you're facing and you're talking to has to take that away and talk to the risk guys or the credit guys, whatever you want to call them, and that needs to fit into their thinking. So coming in with a sort of a sort of a two-pager is going to be more difficult than coming in with a detailed feasibility study. Yeah, just with from a construction point of view, from an existing cash flowing asset point of view, I think it's already been said. It's just a bit around track record, financials, but also in the market and where we're going, and how it's performing versus its peers, and just to give that perspective, because ultimately they're going to be the questions really. It's going to be asked internally.
And just to build on this, and Cyril, looking at your perspective here, what is the timing to involve the banks?
As early as possible.
Well, as early as possible, like
as
for the
possible.
operator. I think the key success factor during this design and construction time before the operation is to keep the banks in total transparency, to keep a permanent dialogue and updates about what's happening in the project. You were talking about operators. The nice thing or the funny thing is that at the beginning of the project, when you select the operator, you start getting some projection from the operator that are usually a bit rosy, that you are sending to the banks. The banks are very happy and providing you some financing. And then there are two factors. Construction get delayed, and when you start operation, you see that actually the operator pushed a bit the figures, and this is not what's happening in the reality. So the key success factor is from the start to the end, keep an open dialogue with the bank and show them fact of life, what's happening on the project.
Disclosure.
Okay. Gentlemen, I'm conscious of time, and I think this stage will start rotating if we don't wrap up now. So thank you. Thank you for joining me, and thank you for your insights.
Thanks.
Thank you. Thank you.
Great. Thank you, Alison. Alison, you've been asking all the questions, so I'm going to ask you. So what are the challenges that you face at RAC Hospitality?
I think for us, it's very much what we've been talking about. It's making sure that the product that we're looking for fits the life cycle of the hotel. You will want something different at every stage. If construction is delayed, you need something that can be flexible with you. You don't want to start repaying your principal before you've opened your hotel. So just having that communication with the bank, having the ongoing dialogue, the transparency, so that we can be flexible and have different products.
And that last comment on the panel about sometimes the figures being a little too rosy, either from the consultants or from the operators, is that a challenge at times?
It is a challenge. Everybody likes to go with something that looks good on a piece of paper, but it has to be realistic. If it's not realistic, it's going to come back and haunt you later on. I think the market is in a difficult position at the moment. It's hard to second guess what's going to happen. In Ras Al Khaimah, we're very fortunate at the moment. We're on a strong trajectory. Dubai and Abu Dhabi are obviously having more difficult times with regards to the fall in the ADR, but that has to be taken into account. Is it something that is going to recover, or is this is the new stabilization?
Okay, great.
Okay.
Alison, thank you so much.
You.
Please show your appreciation to Alison and her